This video is for educational purposes only and is not professional financial advice. Do your own research before investing. SanDisk, ticker SNDK, a company that has been storing the world's data for decades, and right now, something is happening with this business that deserves your full attention. We're talking about revenue growth that has gone from single digits to 251% year over year. That is not a typo. The question we're going to answer in the next 9 minutes is whether SanDisk is actually capturing a massive, expanding market, or whether this is a flash in the pan. We'll walk through the total addressable market, the growth trajectory quarter by quarter, the unit economics that tell you whether this model actually works at scale, and whether the valuation makes any sense given what the numbers are showing. By the end, you'll have a real point of view on SNDK. Let's build it. SanDisk operates in the hardware, equipment, and parts sector, specifically the high-stakes world of NAND flash storage. And the market it's swimming in is not small, and it's not standing still. Mordor Intelligence puts the total addressable market at $76.03 billion by 2031, growing from $58.69 billion in 2026. That's a compound annual growth rate of 5.32%, steady, durable expansion. Market Research Future is even more optimistic, projecting the market reaches $119.95 billion by 2035, up from $78.2 billion in 2025 at a 4.37% compound annual growth rate. Two independent research firms, two different methodologies, one consistent conclusion. The storage market keeps growing. SSDs, embedded memory, removable cards, USB devices, demand for all of it compounds alongside the explosion in data creation across cloud infrastructure, consumer devices, and enterprise hardware. So here's the real question. In a market heading toward $80 to $120 billion, how much of that can SanDisk actually capture? And is it already starting to? Here's where this story gets genuinely interesting. The flywheel is not just spinning, it's spinning faster. Going back to the first quarter of 2024, SanDisk was pulling in $1.53 billion in revenue. Solid, but flat. 0% year-over-year growth for the first 4 quarters. Then something shifts. By the first quarter of 2025, growth hits 22.8%. Second quarter of 2025, 12.7%. A brief dip in the third quarter of 2025 at negative 0.6%. A stumble worth watching. But then it rebounds hard. First quarter of 2026, 22.6% growth and $2.31 billion in revenue. Second quarter of 2026, 61.2% growth and $3.02 billion. And then the third quarter of 2026 lands at $5.95 billion, with a year-over-year growth rate of 251%. That is not continuity, that is acceleration. On the product side, client devices are the largest segment at $4.13 billion, with consumer at $2.27 billion and cloud at $960 million. Geographically, China represents $2.04 billion in revenue, with the United States contributing $1.45 billion. The demand is global, and it is building. Revenue acceleration is exciting, but it only means something if the underlying economics hold up. So let's check under the hood. Gross margin tells a complicated story. Back in 2022, SanDisk was running at 33.3% gross margin. 2023 was brutal. Margins collapsed to 7.1%. 2024 partially recovered to 16.1%. And 2025 came back to 30.1%. That's real improvement, but the trend is officially flagged as compressing, down 3.2 percentage points over 4 years. The recovery is not yet complete. The Rule of 40 score sits at 8.8. For context, the benchmark is 40. You want the combined sum of your revenue growth rate and profit margin to clear that threshold. At 8.8, SanDisk is well below it. The growth is obviously there in spades, but profitability needs to close the gap. On the cash side, the company is burning approximately $10 million per month. But with a runway of roughly 49 quarters, that is not an emergency. It's a watch item, not an alarm. Now, with 11,000 employees generating the revenue this business is producing, the revenue per employee figure is substantial. That's a signal of operational leverage starting to take shape. And that brings us to the multiple the market is assigning to all of this. The current price-to-sales ratio is 0.9 times. Is that fair for what this business is delivering? That's exactly what we dig into next. The price-to-sales history chart tells you something immediately. SanDisk has traded between 0.5 times and 0.9 times revenue going back to mid-2022, a tight, consistently low range. Today's multiple of 0.9 times sits at the top of that historical band. But we're talking about a band that has never been stretched. This is not a stock that has ever been priced for perfection. Now look at the valuation meter. The price-to-sales-to-growth ratio, which divides the PS multiple by the revenue growth rate, sits at essentially 0.00 times. The concept here is straightforward. A ratio below 1 means the market is paying less than $1 of valuation multiple for every percentage point of growth you're getting. At 251% revenue growth and a 0.9 times PS, the market is pricing this business as though the growth is either not real or not durable. That's a bold assumption. 13 out of 15 analysts covering this stock rate it a buy, 0 sells, 2 holds. That consensus aligns directly with what the PS to growth ratio is flashing. On price targets, the lowest single analyst target sits at $450, well below the current price of $1,663.06. The average of all analyst targets is $1,790.31, implying modest upside from here. The highest individual target is $3,100. The street is not running from this one. Every compelling growth story comes with real risks. Here are the ones that actually matter for SanDisk shareholders right now. Cash burn. The company is burning $10 million per month. The runway is long at roughly 49 quarters, but sustained negative free cash flow means the business is not yet self-funding its own growth, and that changes the calculus quickly if revenue momentum ever stalls. Multiple compression. At a 0.9 times price-to-sales ratio, the stock looks cheap relative to growth today. But growth stocks are sensitive to interest rate shifts and broader sentiment changes. A risk-off rotation could compress multiples even on a business delivering real numbers. Competition and disruption. SanDisk operates in NAND flash storage, a capital-intensive arena where well-funded rivals like Samsung and SK Hynix compete aggressively on both technology and price. Structural oversupply cycles in memory markets have crushed margins before, as 2023's gross margin of 7.1% painfully demonstrated. Gross margin recovery risk. The margin trend is still flagged as compressing. If pricing power does not return as strongly as 2022 levels, the Rule of 40 score stays buried, and profitability remains a question mark. On the catalyst side, the acceleration in revenue growth to 251% is the single most powerful signal here. If that reflects a genuine demand supercycle for storage, driven by AI infrastructure, cloud build-out, and consumer device proliferation, the current valuation leaves enormous room for re-rating upward. Here's where we land. SanDisk is a hardware company in the middle of something that looks less like a recovery and more like a structural re-acceleration. 251% revenue growth, a price-to-sales ratio under 1 time, a PS to growth ratio that rounds to 0. The market is essentially treating this growth as if it doesn't exist. The bull case is straightforward. AI infrastructure, cloud storage, and consumer device demand create a multi-year tailwind that keeps the flywheel we saw in that revenue chart spinning faster, and the valuation has nowhere to go but up. The bear case is real too. Gross margins are still recovering, the Rule of 40 is well below benchmark, and NAND flash markets can turn brutal fast. But on balance, the verdict here is growth buy. The growth is accelerating, the multiple is historically low, and Wall Street's own consensus backs the thesis. This is not a stock without risk, but it's also not one the market is paying full price for. Do your own diligence, size it appropriately, and watch those margin trends closely. The setup is compelling.